Hi, welcome to this podcast where I'm going to be looking at changes to profit share ratios. Okay, we've got a partnership agreement here where Alf, Evelyn and Arthur are on a partnership and they've been sharing profit equally, but from the 1st of January 2020, they've agreed a new profit share ratio of 2 to 2 to 1. And we've got some information here from their statement of financial position and some other information underneath. The information underneath says that the non-current assets are going to be revalued to 130,000, so they're going to increase by 30,000. And as with all of the changes that we've been making in partnerships, we're going to split that profit of 30,000 between the partners, and we're going to use the old profit share ratio, which was equally. So what we need to do is to credit partners account because we debit the non-current assets account by 30,000. It's probably going to be related to some property. Okay, we're also told that the current assets are going to be revalued down to 49,100, and that's from 50,000. So what we're going to do there is there's 900 of, if you like, negative capital or a loss, and that needs to be split equally. So again, each partner is going to get this time a debit entry for 300. Okay, and that's going to reduce their capital because it's a loss. Goodwill is going to be valued at 60,000 and it's not going to be kept in the books. So first of all, when we give the goodwill, we debit the goodwill account because it's an asset, and therefore we need to credit the partners, and we need to credit them in relation to their profit share ratio, which in this case is going to be equal. So each partner gets credited for 20,000. And then the final thing we need to do is we need to take that goodwill out because they're not going to keep the goodwill in the books. So this time we need to do 60,000 divided by 5, which comes to 12,000. 12,000 is one share, and therefore 2 shares for Alf and Evelyn is going to be twice that, or 24,000. So we need to put a debit entry in for 24,000 in Alf, 24,000 in Evelyn, and 12,000 in Arthur's account. And the corresponding credit entry will be to make sure that the goodwill account balances off. Now, if you haven't got this bit of information down here, that would be the end of it really. Work out the balances carried forward, and that would be the amount of capital that each one of the 3 partners has in the business. But it's not. I've got this little bit of information here that says capital is to be valued at $150,000 at the end, with each partner having capital in relation to their profit share ratio. And the adjustments are to be made either by paying money into or withdrawing money from the capital accounts. So what does that mean? Well, it means that in total, partners want to have 150,000 of capital remaining in the business, and they want that to be in their profit share ratio. So 150,000 divided by 5 times by 2 means that Alf, needs to have 60,000 of capital in the business, as does Evelyn, because she's also got 2 shares. And Arthur only needs to have 30,000 in the business. Okay, so the total capital now in this business is 150,000. Now, as you can see at the moment, the debit sides are going to be, for some of the partners, different to the credit sides. And for Arthur in particular, he's going to have a much bigger credit side than debit side. So how are we going to balance them off? Well, we balance them off with the amount of money that we either got to put into the business or to take out of the business. So Alf, if we weren't doing these adjustments, would have 50,700 of capital because we add up his credit entries, and they come at the moment to what, 55, 75,000. We need to take off these two debit entries, and therefore at the moment Alf has got capital of 50,700. He needs to have capital of 60,000. So what Alf needs to do, he needs to pay some extra money into the business bank, 9,300 in this case. Okay, and hopefully now what we'll see is that Alf's account now balances off. Got 84,300 on the credit side, 84,300 on the debit side. Got a balance CD in there, and he's got a balance BD of, oops, of the same amount. Okay, same thing for Evelyn. Evelyn's got 45,700 as a balancing figure if we weren't trying to make the balance CD 60,000. So she needs to pay in 14,300. Okay, but now we come to Arthur. Well, Arthur, in theory, would have 57,700 as being his capital figure to carry forward, adding together the credit entries and taking off the two debit entries. But he only wants to have 30,000 of capital remaining in the business. So there's a difference there of 17,700. And in Arthur's case, he needs to reduce his capital. So he needs to take some money out of the business. He needs to take out 17,700. Okay, and if we now have a look at the other two partners, hopefully now their accounts are going to balance off. And then importantly in an exam, to make sure that we don't lose any marks, we need to make sure we've got both of the balanced BDs in. So where this is different is it's simple, just follow the rules that you will have done with other capital adjustments for partnerships. If there isn't this sort of rule about how much capital they each want to have at the end. But if we do, we need to work out what the capital each partner should have at the end is first. And then once we've done that, work out how much capital they did have after we've done the adjustments for goodwill and any changes in asset values. And then we either need to add money as being paid in by each partner, as we did here for Alf and Evelyn, or we need to take some money out of the partnership bank account as we had to for Arthur. Okay, it's a little bit of a tricky one, but you've got